This is INBrief with Manusha Samaraweera, Fixed Income Investment Director at Capital Group. First of all, Manusha, thank you very much for making the trip down from Singapore to attend and participate in the Inside Network's Investment Leaders Forum, Noosa 2026.
Thank you so much for having me.
It's a great pleasure, Manusha. Fixed income is back in focus after a long period of, you could say, adjustment, but even for a period of being shunned. Where are you finding the most compelling opportunities in the asset class today?
Yeah, I think it's fair to say that fixed income was one of the most hated asset classes for a period of time. And when you look at the results of 2022, it's kind of understandable why people felt that way. But I think the word that you used just then, adjustment, is actually a very good description of what's happened. We've basically seen a situation where fixed income now is in a very different situation to what we saw in 2022. Interest rates are significantly higher, and the defensiveness of the asset class is back. So I think one of the key things that you can get from fixed income today, very boringly, is the fact that you can just get income by just diversifying your opportunity set. So the way that we think about income is diversifying across multiple sectors of the fixed income market: global investment grade corporates, high yield corporates, emerging markets debt, a bit of securitized debt, and you can earn a very good income today in a defensive way.
With yields higher, as you said, but uncertainty elevated, to put it mildly, how should advisors think about balancing their investment clients' portfolios when considering duration risk, credit risk, and the effectiveness of the income that the asset class is generating?
Yeah, so again, I think you use the word, again, balance. That's exactly the way we think about it. So balance, we think, is very key in today's environment. In the past, it made sense to concentrate risk to specific areas. So it made sense to just take credit risk or just take duration risk, because when interest rates were low, you had to make that call. But today, the environment is different. You can basically earn a very good income by balancing across various different risks. So again, the way we kind of think about it is credit risk is a very good place to be today. Credit fundamentals are very strong. Leverage in the system is quite low. So from that point of view, it's good to have some exposure to credit. At the same time, you should balance that out with something that'll help you in an economic recessionary type of scenario. And that's what duration does. You shouldn't have too much duration. Having too much duration gives you more risk to inflationary type of situations. But as long as you've got enough to help you, protect you in the event of like those kind of downside environments, we think that kind of 5-year type of level, that sounds about the right amount.
Within global fixed income, where do you think investors most often oversimplify the opportunity set? And conversely, what across the opportunity set, what sectors deserve a really nuanced approach?
Yes, I think government bonds need a nuanced approach. I think a lot of people, again, with 2022 fresh in their minds, they think about the potential of kind of sell-off again, especially with the current situation with higher energy prices, what that could result in with respect to inflation and how that could change the trajectory of government bonds. But I think the nuance there is remembering that we're in a vastly different world to what we were in 2022. As a starting point, central bank policy rates are significantly higher today, literally hundreds of basis points higher than what we saw at the beginning of 2022. So the extent at which central banks need to increase interest rates, even in the face of higher inflation, is significantly different today. So the outcome, I think, is also very, very different. The other thing to keep in mind is that back in 22, it was more than just a supply side energy shock. It was also a demand shock. We were all traveling a lot more because it was after COVID. We were spending a lot more. We were, enjoying our freedom for the first time in a couple of quarters at least. So from that perspective, it was not just a supply side shock we saw in 2022. It was actually also a demand side shock. Whereas in today's environment, that demand side shock is not there. At least the evidence of it is very minimal. So from that perspective, again, I think that kind of inflationary pressure, even though we could see it a little bit in the next few months, possibly quarters, it's unlikely to be to the same extent that we saw in 2022. So I think the role of government bonds, duration, which we kind of talked about a little bit earlier, I think needs a more nuanced view in today's environment.
And within the global opportunity set, there's things like the emerging market sovereigns emerging as a really interesting place. And there's also this development where the Stocks like the Magnificent Seven, some of the big mega technology companies in North America, have actually become a credit story recently and not just an equity story.
Yeah. Well, the exciting thing for us in the fixed income world is that AI is an investable story. I know a lot of people don't really draw the link between fixed income, at least public market fixed income, and AI. But the reality is AI is offering us amazing opportunities. And you mentioned a couple of big names that are already coming to market, the big hyperscalers, the big technology companies. But it's more than that. It's also companies that can use AI really effectively. So big pharmaceutical companies, they can use AI to help with their drug manufacturing and drug discovery. That basically just means that the bondholders get paid back quicker and more securely. So there's a lot of really great ways that we can kind of tap into this AI story and really make it into an income story for clients.
And a 100-year bond from Alphabet, that's quite surprising.
It is. That was a longer one. That is a longer one. But it's a reflection of the fact that markets are ready for this and they're looking for this kind of opportunity. They're looking for a way to diversify their income streams and they're taking advantage of that.
Manusha, across your career in markets and investing, what's the best piece of investment-related advice you've ever received?
Yeah, so I'm going to cheat a little bit for this one, and I want to read out a quote which I really am quite fond of, and I think it's a really good way of thinking about just investing. And it's a two-part quote, so bear with me. So the first part of the quote sounds like this. Okay. We have a new president, strife in the Middle East, excessive government regulation, oppressive tax rates, and a Congress that is more part of the problem than the solution. So nothing sounds very amazing or exciting about that quote. What is quite fascinating about that quote was that it wasn't written recently, it wasn't said recently, it was actually said back in 1981. So the rest of the quote goes like this. In my 25 years in my 25 years in the investment business, I have never known a good time to invest. There is always a dozen reasons why it makes sense to wait. Just imagine if you had to wait, or if you decided to wait back in 1981, you decided to get your money out of equities, get your money out of bonds, put it into cash. You would have missed out on decades of incredibly, incredibly strong results. So this is something that I think we hammer home when it comes to investing. It's not about timing the market. There, as that quote said, which is by Graham Holloway, a very tenured person at Capital Group for a very long period of time. I guess the magic behind that quote is the fact that staying invested for the long term really pays dividends. And if you try to, focus too much on trying to time the market, getting in the market at the right time, you actually miss out on a lot of really good returns. So that's something that I think is really important to keep in mind.
There it is, the secret of investing in the fixed income and credit markets. Manusha Samaraweera from Capital Group, thank you very much for your time today.
Of course, thanks again for having me.